afternoon, good evening, wherever you're watching from at this hour. Today is the 2nd of November 2021. It's a start to a new month, and I hope our month will be profitable. So this morning, I'm going to be spilling a bitter truth that a lot of people don't want to hear. But before we start, please, I indulge you, please subscribe to our YouTube channel. If you are a new viewer on this channel, please subscribe to our YouTube channel. And if you are old, please turn on the notifications so you can get first-hand update once we go or post a new video. So please subscribe to our YouTube channel, follow us on Instagram, follow us on Facebook, and please turn on the notification on your YouTube channel. So this morning, what I said is I'm going to be spilling a bitter truth, which I believe a lot of people, newbies, wouldn't want to listen to, but it's the bitter truth. You need to have this at the back of your mind. Know this and know this well. You say in forex trading, no one can do it for you. No one can do it for you. You have to do it yourself. You have to do it yourself. Yeah, it's good for you to gain a lot of knowledge from watching educational videos on YouTube and other spaces, to have the basic knowledge. But at the end of the day, you have to have this your memory that, yeah, no one is going to do it for me. After watching these videos and having some pointers from watching educational videos, I need to now sit down and now do a deeper research on what is required from yourself in the market so you can be profitable. That's one thing that a lot of people come into forex trading. They don't want to hear you speak and speak and speak, but they don't want to listen. What I have noticed now with this newbies coming into forex trading is that they listen to a lot of people, a lot of noise. They get this theory from this one, they get this theory from this one, they get this theory from this one, and now they are now affected by theory-induced blindness, because a lot of theories now, they don't know what to apply in the market to become profitable in the market. Because you see, someone can wake up in the morning now and decide to open a Facebook page and name it ABC Forex Trading Academy, and then you see people now going into that space, because it is easy for anyone to open a channel and then becomes an instructor. So one thing you need to know, one thing I've always advised people coming into forex trading, look for someone that can give you pointers on how he arrived at a certain level. Don't look for people that are only interested. That's one way to spot. Don't look for people that are always interested in showing you the results. They are showing you the result. They are opening you MT4 in order to show you the money they made, but they can't put you on, give you the white paper on how they got to that conclusion and how they got to that result. So you need to have this at the back of your mind. Say yes, get a lot of knowledge from educational videos, that like what I'm going to be showing you now. I'm going to be showing you one of the first. You can apply this in forex trading. You can apply this in investment when you want to pick like an instrument you want to invest in. So I'm just going to give you like a breakdown of it. Then if you want the white paper of this, you can make a comment on the comment section, or you can email me. Then I'll give you a breakdown on how I got to this conclusion, so you can apply this. Why this thing is very good is you can apply this in forex trading, and you can apply this in investment as well. Let's say you have some funds that you want to invest in and get a return in the year end, so you can use this method to know, okay, do a 10 years moving average, and then check if the CV is the volatility on that particular instrument. How was the volatility? Is it something that I can manage? Is it something that cope with, then you can get the CV of this particular instrument, compare it with the CV of another particular instrument to know which one is safer for you to invest in or open a trade on, and so you can be profitable in the long run. Because this one thing I've always said, and I don't know what more to say on this particular. You see, people just want to dive in. People just want to dive without doing a proper back testing on what they are actually going into. So I'm going to show you something that one of the major things that I do first before executing any trade, and you can apply this as well. And if you want more details on this particular video, please, you can drop a comment on the comment section, or you can email me and I will give you the white paper. You see, like I said, no one can do it for you in forex trade. I can give you pointers, but at the end of the day, you see, my white paper on how I trade can only be given to people. Maybe let's assume I'm mentoring some people so they can follow me. I can give them 1, 2, 3, 4. This is my white paper now that you can use to execute on your trade. But then on the YouTube channel, I can give you pointers on look. Now it's now left for you to go on your own and do a deeper research on what the market requires from you, so you can be profitable in the market. So don't be deceived by these people that comes online to show you a result, but they can't show you how they arrive at that result. So I'm going to be showing you something now, so you have this at the back of your mind. You can compare it. This is one thing I do before the year starts. I've already started. I've started this now because I know my December will be very busy because I will be traveling. So I need to get the instrument that we'll be trading on next year, because someone said, I see this a lot on data, we are killer, we are forex chaser, we are forex killer, we're killing. No, you can't finish the market. The market is too broad, is too large for you to. There's a lot of instruments for you to trade on. It's the market that will finish you, it's not you that will finish the market. Even with this, our company having over 18 live accounts, we still need to check on before the year starts. We need to check on the instrument, do a 10 years moving average to see the trajectory of that instrument, and to check the volatility of that instrument, to compare it with other instruments and know, okay, what's my risk appetite, or what's my risk appetite, and what am I looking for? Do I need a safe instrument that I can invest in, and even if at the end of the year I get a 20% return, I get a 50% return, I'm okay? Or is my risk appetite high that, okay, let me look for a volatile instrument that I can trade on? My risk appetite is high, and then it also has to do with your account balance, to know, okay, can this account balance? Do I have the fund that will cater for this particular instrument that is highly volatile? Or if I have a smaller account, let me look for an instrument that is not highly volatile that I can invest in, and then leave it at the end of the year. If I get a 30% or 40% return, I'm okay. So these are the little details you need to put into consideration before executing and picking an instrument that you will be trading on in that year. So I see a lot of people, this one, you see this one telling you that it's trading on Nasdaq, you see this one telling you that it's trading on US 30, you see this one telling you that it's trading on S&P 500, you see this one telling you that it's trading on the Dow and Jones and all that, and then you are confused now. But they can't tell you how they arrived at that conclusion, because I always tell people, your account size should be the determining factor of what you are going to be trading. Don't say because I am trading on Nasdaq or S&P 500, and then you go and dive in, you that have an account size of, let's say, $4,000, $5,000, or let's say $2,000, you now go and dive into trading S&P 500, and you even check if it is highly volatile, to know, okay, one candlestick from this trade can wipe out my account, or twice can wipe out my account. So these are the little details you need to put into consideration. The reason why I'm going to show you this now is to have this at the back of your mind, to know, okay, if I want to get the CV of or the standard deviation of an instrument, to know if it is highly volatile, comparing it to other instruments. Let's say I can take US 30, and then you pay it, let's say S&P 500, and then you can check the standard deviation of US 30, check the standard deviation of S&P 500, and compare it and see the one that's highly volatile, so you can embark on a profitable journey. So because this, what I'm going to show you now, you can use it on investment. You can check, okay, let's say a US what's it called, Aussie USD, or pounds, yen. You check this instrument so that you know what you will be trading on in that year. You see an instrument that has a trending trajectory of an uptrend, doing the back testing to, let's say, 10 years moving average. So let me just show you now, so you can let me share the screen so you see what I'm talking about. Then you understand what you need to do. I don't want this video to be short, too long, so I'm just going to show you this now. This is what I did. Let me increase this. Let me put it here. This, like I said, I've already started checking on what we're going to be investing in next year. I need to be ahead. I don't want to that's one thing that I like. That's what I said to you. See, in forex trading, no one is going to do it for you. You need to have this at the back of your mind, that yes, you need to do it yourself. That's what forex trading is all about. Forget these people that are telling you, come and get the 10 what's it called, the 10 technique of how to become this and this in forex trading. No, have this at the back of your mind. No one is going to do it for you in forex trading. You have to do it yourself. Yes, it's good to get a lot of pointers, from educational videos. When I mean educational videos, I mean educational videos from people that you know that they know what they're doing in the market. From people that you know they can analyze for you and tell you, look at what I'm saying here, and then you go with these people, then you get the pointers from them, then you now go back on your own and do a deeper research on what is required from you to become profitable in the market. That's how to become profitable in the market in the long run. Don't believe this people that say, come and join the WhatsApp group, come and join this group, we'll be sending you. No one can do it for you. If they are that good, you see them, they won't be busy online looking for people to come buy robotic signal. Get this straight today. Is the bitter truth that no one wants to tell you. No one can do it for you in forex trading. You need to do it yourself. Get the basic knowledge. If you are following someone, I cannot provide you my white paper on how I trade. I can only give to let's say I'm mentoring some people, I can give them my white paper. It's just like Satoshi had a white paper of Bitcoin that he developed. He didn't give it, he presented it. Ethereum came out, used that as what's it called, a pointer to what they will also do on their Ethereum blockchain, and they also have their white paper. So you see, I can give my white paper on my step trading to people that I'm mentoring. But then you need to have this at the back of anyone telling you, come and dive in. Don't know. Have this at the back of, no one is going to do it for you. Is do it yourself at trading, because there's a lot of opportunities in the market. That's one thing you need to know. There's a lot of opportunities in the market. So you need to put in the hard work. It's not for lazy people. You need to put in the hard work. So this one thing I said I'm going to show you. This is how I, first of all, these are a Pfizer, checking the 10 years moving average. This is on a monthly time frame, checking the 10 years moving average. So this is the first thing that I do to check the volatility and to get the CV of a particular instrument, get the standard deviation first of a particular instrument to know how highly volatile the instrument was. Then from there you spot some outliers, and then you go and investigate the outliers. This is the beauty, the beauty and the joy of investment and forex trading. If you can, I say, if you can put in the hard work, you see it's not an easy task, but then you see when the reward comes in at the end of the year, you are happy. You are happy. It's not looking for someone that wants to give you robotic signal. You are online checking for robotic signal, looking for anyone that just want to open a Facebook page and then name it ABC Forex Chaser, Forex Killer, or Forex this thing, and then you dive in. They don't know what they're doing. Look for educational videos online on YouTube. There are a lot of educational videos online that will give you the basic knowledge. Then you now go on your own to sit down and say, yes, now I have these pointers. Now let me now put in the hard work and get a deeper understanding of how the market operates. The psychology that links all traders together is not just about what's it called, technical alone. You now have to then go into knowing the fundamentals that is attached to a particular instrument, like getting this now is a 10 years moving average that I did. Now I did this thing yesterday. I only posted it on my personal Instagram page because I knew I would be speaking on it today on WhatsApp, on YouTube. So I will be posting it now on our YouTube channel. Then also I will post it on a section on our Instagram page, so you can view there and then view the complete video here. It's not that this is just the first step to what I'm actually looking for. It's just I use this as an example because there's a lot of new companies now coming up, springing up now because of this. You know, we are the global warming, the pandemic. Pharmaceutical companies are coming up. Now we have a lot of companies on renewable energy coming up. So I've already listed those companies that now what I need to do now is to go check if they are actually trading at their intrinsic value to get their standard deviation, then check their 10 years moving average to get what I'm looking for, to know, okay, this is a good company to invest in, so that at the end of the new year, we check the one that is currently trading at their intrinsic value now, we invest in, and then we wait for those ones that are not trading at their intrinsic value at that time to see if they can do a pullback before we can invest in. And then you see yourself at the end of the year, you are happy because why? You made a lot of profit, you are happy, people around you are happy, and life goes on. So this is what I do to get the first of all, my major target is to get the standard deviation, which then I will now get the coefficient of variation, the CV for this, the Pfizer 10 years moving average. So after this now, what I now do now, I get the companies. After getting this CV of the coefficient of variation, that's what the CV for aggregation. So once I get this now, what I will now do now is then I'll go on to pull out the company's financial statement, so I can get the cash flow of each year to now get to know if the company is trading at their intrinsic value at that time. So this is just the preliminary stage, which I said you can also use for forex trading. Why did I say you can use it for forex trading? You can also use it for investment. Sometimes you have, I don't want this video to be long, I'm just trying to rush it. There are sometimes you have some funds that you know, okay, throughout this year I won't be using this fund. So the best thing for me, instead of me to put it in the bank, that the bank might give me 8% or 6% or 10% at most, let me look for a company that I can just put this money at the end of the year. I know, okay, I will get a good return, even if I get 30%, 40%, 50%. Then you can do this, calculate this, and know, okay, this company they have had in their 10 years moving down, they have a good trajectory. Get the cash flow to say, okay, the growth is there. And then sometimes you spot an outlier, then you investigate an outlier. Like, what's an outlier now on this trajectory that we're seeing? And we have seen the trajectory since January 2011. Now we saw a trajectory, a movie, a trend. Then we now saw a fall. We're expecting this fall to respect this level again, but no, we now saw this candle. This on a monthly time frame. This candle was March 2020. This was the candle on March 2020. We saw this fall here, so this becomes an outlier. So then you now go and study, because the reason why I says it was an outlier. So when immediately it touched base there, it did a retrieve immediately down to go respect this level that we were expecting the candle to respect. So this was an outlier. So what happened on this day on March 2020? Then you now say, oh, okay, what will actually happen? Then maybe you go and say, okay, this company, there was something that happened, or let's say it was due to the pandemic, due to COVID. Maybe they they were applying for approval from the CDA and all that. Maybe they had some fundamentals that crept in on that day. So if you can validate this outlier, once you can get why this thing happened, the fundamental that occurred, then this now becomes this outlier becomes invalidated. So you can say, okay, this was just a blip, it was an outlier, maybe it's fundamental correcting. So and it quickly reacted and then respected this level, and then we are seeing another trajectory now. So getting the standard deviation of this particular list, you know that, okay, this company is not highly volatile. Like what I did, see, let me just, okay, this is what I did. That's how I do my I like to detail my, if you're following this channel, if you're following us, you know that I'm someone that like to detail my chart and know what I'm doing. So that even if you that is a newbie comes and see this, you know what, oh, okay, look. Then if you want more details on how I arrived at this thing, you can send us a message on our email. Go to our website, you can send us an email, then I'll give you the white paper on what I did, so you can apply this on any particular instrument. So you can say, okay, on the year I want to trade on a US dollar yen, or I want to trade on Aussie US dollar, I want to trade on US dollar yen, I want to trade on CAD yen. So you are confused now, then you now go and check which one was highly volatile on this thing, that you know, okay, I can trade with my mind at rest. I can trade with my mind at rest. So you check all these things and say, okay, US dollar yen wasn't highly volatile for the past, so it has been following a trajectory, or it has been following a downtrend or anything. Then so you not trade on it and do a price action to know, okay, this is where we're going to now on this month trade, and then on this there's a pullback, you know, okay, there has been a pullback on this certain level and all that. You get to this little detail, that's how you become profitable. So you see a 10 years moving average. So what I did first, now this is the cash flow. I've not gotten into this cash flow. This is just me getting the coefficients of variation, getting the standard deviation of this particular instrument to check the volatility of this instrument. Now what I need to do, I need to pull out the 10 years move. That's where the hard work now comes in, getting the intrinsic value of a particular company. So now what I need to do, I need to print out the what's it called, the financial statement of this company dating back to 10 years to this thing, to get the cash flow of each year, so that I can use it now to calculate and get my intrinsic value, to know if the company now is trading at a right intrinsic value that we can buy, so that even at the end of the 2022, God willing, we can at least, even if we can get like 30-40% from this peak on our investment, is a big win for us. So now we say a 10 years moving average. So this is cash flow, is to get the intrinsic value, cash flow, year 1 year, 2 year, 3 year, 4 year, 5 year, 6 year, 7, 8, 9, 10 years. So this is not what we are dealing with now. This is to get the intrinsic value, which I need to pull out the financial statement. So what I did first is the price, that's the high of that year. So the high of this year of this year one was 20. It was trading at 20. The highest it traded was $20.29. The year two, 26.05, year 3, year 4, year 5, year 6, year 7, year 8. Now the mean of this instrument is the amount. When I did it yesterday, the amount, sorry, excuse me. As the current price the instrument is trading with, you see the mean is all the same. Now to get the standard deviation, now you minus these two, the price from the mean, to get the deviation, sorry, of each instrument. Then you now square, this is the squared deviation. So you square root of this deviation. This is a calculation. It has to do with calculation, which I said, if you want more of this, let me know. I will give you a white paper of this for free. I'm not charging you anything. That's what you need to put in the hard work. I'm not charging you anything, but then I'll give you the blueprint on how to do it. Then you now go on your own, take a pen and a paper, then you start do your calculation to arrive at what I got. If I say to you, okay, this is how I got this, then you now go and check it, calculate your own, and then say, okay, then you cannot pick any instrument and use the same pattern to arrive at your own conclusion on this same instrument. If you like, you can also forward it to me after coming to a conclusion on an instrument. Forward it to me, and I will still check and say, okay, yes, you did well. And then if there's any error, then I will still address it. That's how you become a good forex trader. So now we get the deviation square of this instrument, calculate it, then to get the variance in of this, then we square it to now get the standard deviation of this particular instrument, which was now 11.84. So with this, if I got 11.84 from this the standard deviation, $11.84, it means this instrument wasn't highly volatile. So it's a safe investment. It's a safe investment for people that don't have a huge risk appetite. So it's a safe investment that you can just put in the money and just leave it there. You know, okay, well, you can get 20% from it, you can get 40% from it, but it's a safe investment because there's a trajectory here that we have seen. There's an uptrend for the past 10 years. And knowing that fully well, because this one is we invested in this company before, but then this was we were out of this. We closed our position when we're in profit when we closed the position, because then the CDA and all that, this approval of this vaccine, and I know this company is going to do well. So I'm just waiting for a little pullback to trade now, so we can get into the market, and then that will be for next year. So if you see this now, you say, okay, this peak, it hasn't been that volatile, which means it's a safe investment. So now you see now the coefficient of variation CV for the for Pfizer now is 27.07. So it means between this time and this time we have had plus or minus gain of 27.07. Even with the pullback and all that, it has been on plus 27.07. So if I now decide now to get intrinsic value, first of all, I know that by next year we are going to see a continuation, because there's a lot of fundamental that's going to push this. Honestly, there's a lot of fundamentals that's going to push this, because Pfizer now got approval to start administering Pfizer vaccine on kids. So there's going to be a lot of fundamentals that's going to push this, that we can break out on, or even get like 100% return from this instrument. But I still need to get the intrinsic value first to know, because one thing I've always said, I've come to realize, is that it's not all the time that you get a company that's trading at their intrinsic value that will trade at their intrinsic value. So that's where common sense also needs to come into play in. And okay, if let's say the intrinsic value of a particular instrument is $44 per unit, and is trading currently at $60 per unit, this is not close. So you can say, no, this thing, there's no, you can wait and say, look, let me wait for it to do a pullback. And then let's say now there's the intrinsic value of this particular instrument is $44 per unit, and it's trading, and there's a lot of fundamental that that is going to push this thing now out, and this instrument is trading at $46 or let's say $47 per unit. So you don't wait for, sometimes common sense needs to come in. So you don't wait to say, okay, until it comes to 44, I'm not going to invest, I'm not going to buy because it's not trading at the intrinsic value at that time. But common sense needs to play and say, okay, $3 difference, $3 difference. Should I wait a little bit? And if there's a lot of fundamentals, like I said, there's a lot of fundamental that's going to push this instrument now to another all-time high and break out from another all-time. I will see a good trajectory in the next year. So you pick it. $3 is not that much of a difference. So you pick, but if it's trading, if you know that the intrinsic value is $44 and it's trading at $60 or $70, there's no sense in picking that instrument, because we're going to see a pullback. That's where the intelligent investors and the amateur, that's what separates them. Because then if instrument is supposed to be, if you know the intrinsic value of an instrument that is $44 and it's trading at $70, an intelligent investor will wait for it to at least do a pullback before he can invest. But an amateur that doesn't even know what is an intrinsic value will open a position at $70 and set up let's say a stop loss at $50 per unit, and then we'll see a pullback. The instrument now actually does a pullback to go expect that intrinsic value to open. Then you're already at 50. An intelligent investor waits, maybe it gets to 45 and open a position, and then we'll see a pullback again. So it goes back to 70 or goes back now to 100, and the intelligent investors have already made a little bit of profit. So that's what you need to know. Know this, that no one is going to do it for you. Get that into, have this at the back of mind, and no one is going to do it for you. There's a lot of opportunity. You need to put in the hard work, hard work, hard work, hard work. Don't be lazy. Don't be lazy. You need to put in the hard work so that you can be profitable in the market. So this is one thing I wanted to show you. So like I said, please follow us on Instagram. Please subscribe to our YouTube channel. Turn on the notification so that once we post that a new video, you will get it first. And so if you still need more information about how I arrive at this conclusion, please DM me or WhatsApp message us so that I can give you what's it called, the more details and more information on how I arrived there, so that you can do it on your own. Once you finish, pick on an instrument, get this, and you can send it to me, then I'll check it and see if there's something that you missed out and there's something you can improve. So have a lovely, 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 lovely day. I'll see you when I see you. Bye bye for now.